Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we're back on YouTube and we're looking at the SPY, which is our proxy for the S&P 500. We're also going to look at the PCC and the VIX. Right, before we get into the Elliott wave count, just want to have a quick talk about how there is some bearish sentiment building up, right, into these highs. I've mentioned it myself, and generally there's weakness into these highs from a technical point of view as well. Okay, so we might be approaching a broader pullback. It's not confirmed yet. We are in an upward trend of higher highs and higher lows, and the trend is your friend. Right, now what I am going to tell you is you need to manage risk. You need to manage risk and you need to manage exposure, and you need to understand the two. Okay, now I have a video which teaches about it, and I insist everybody who joins the Patreon watch it, understand it, and take responsibility for it. You don't have to agree with me, you don't have to do it my way, you can do it your own way, but everyone should be managing risk, okay, because there's no reason not to. If the market crashes big time styly over long term, right, weeks, months, maybe even a year or two, we should welcome it like a salivating dog welcomes a juicy steak. That's exposure time. That's time to get exposure back up to 80, 90, 100%. Okay, but what if I told you that you could have exposure at 50, 60, 70, 80, 90% or lower, right? But your risk never has to get above 10%. And it's not rocket science as to how to achieve that. It's pretty simple. Okay, and that's where your risk should be. Now, that's me talking. They're my rules. You do what you want to do. If you want to have 100% exposure, 100% risk, and you want to wreck yourself, that's fine. But just be aware that if the market were to crash tomorrow and you got wrecked, that was your choice. You chose to get wrecked. Right? You could have just chose to manage risk and not get wrecked. Okay, that's also a choice. In other words, we're grown-ups and we should be in a grown-up world. This is not a computer game. This is real life. Okay, so let's trade it and treat it with respect. Now, that's all I'm going to say on the matter, because I don't want this to turn into a horrible, boring lecture. But I will give you a very quick example on the shorter term of how minimal a risk anyone has to take at any one time. Now, I'm not going to go into detail. I go into detail on separate videos on the Patreon, but I'm just going to point out we're in an upward trend of higher highs and higher lows. The most recent swing low pivot we have is back here at 575.35. Stop loss. Right, we have a 5-wave move up and what looks like 3, 3 and 5 down. That's a flat pattern, if you know Elliott wave. A, B, C. Could be part of a bigger structure, we'll talk about that in a minute, but we're doing this as an exercise. Now, you know, if you haven't watched my Bitcoin video, go and watch it, but I spoke about that yesterday, and I just shared an STS video with my patrons telling you how to enter the trade from in Bitcoin off of those recent lows and to do it with minimal risk. Okay, and how to manage that risk. Everyone knows I bought yesterday around 80k. Okay. Difference is I had to explain to someone in private who was testing me, who said, you know, oh, you've gone up. Normally, Tom, you wait for 5 up and 3 back before you trade something. That's your own STS program. That's true, and I do. But just as there's a difference between risk and exposure, there's a difference between investing and trading. That Bitcoin stays with me till death now. Okay, that's not a trade. The STS program, the STS video I put out on it afterwards, that's talking about a trade. That goes into your trading portfolio. That goes onto your books, and the risk has to be managed. End of story. So let's say we take the exact same principle. If you're not interested in this, skip forward, watch the Elliott wave stuff. I'm just trying to help. So if we were to enter on the open yesterday, in the upward trend off of that prior pivot where we've seen 5 up and 3 back, buying into the fear, right, which I did in Bitcoin, buying into the fear, buying into the panic. We had a risk of 155 basis points off of that low. 1.55. If you didn't quite ace it, maybe 2.29, right? If you ran into the close at the end in a panic, I've got to get a piece of this before the weekend, not a way you should be doing things, really. Emotionally trading like that. But even then, it's 317 basis points, right? If you're not leveraged, that's nothing. That is manageable risk. Okay? If that's the only trade you've got on your books and you've got no stops which have been moved up into profit to 0 risk percentage against your overall exposure, that's the only trade you've got on right now that you took yesterday, you've got 3.16% risk. If the market implodes over the next week, you're out. Go put your feet up. Go wait for the apocalypse to unravel. Alright, no worries. Wait for the market to form another low, wait for the market to form another swing high and another higher low. Trade off of that pivot instead. Manage risk again. If you've been in this market the whole time, you have options, right? You have options that people who've just gotten in don't have. That's the option that people who've literally just gotten in the last few weeks have got. Pretty simple one. Pretty manageable, right? But if you've been in it for a long time like I have, you've got loads more options. First of all, you've got trades set up all through all of this which are still running. Well, you should have, because we back the winners, right? When a trade's winning, we continue to increase exposure towards that trade. We back the winners. We double down on the winners, right? And we have zero patience for the losers. We cut them as fast and as quickly as we can. We do not hold on to losing trades. We back the winners though, right? So as we've been climbing up through here, and our long trades have just gotten healthier and healthier and healthier, we don't just leave our stop at a loss, we move our stop up into profit. That's now a zero risk trade. That trade, if it gets stopped out at a profit. That's zero risk to the portfolio. The exposure of the trade is still there, the overall exposure within the portfolio, but the risk is gone. So you have the advantage of moving those stops into profit, but you also have the advantage of choosing to reduce the overall exposure, which is called taking profits. We close the trade and we move back into cash. We reduce the overall exposure. My overall exposure is now around 50%. I have to have skin in the game because we're in an uptrend, and the only way to keep making money is to back it, right? Stay in the game, put your chips on the table and play. The only way to win is to play, right? But I've reduced the exposure because I feel that the risk of the game soon coming to a close is increasing. But I'm managing, that's the exposure, but I'm managing the risk way tighter. And this is what I mean. So I'm going to leave the lecture there. But this is a grown-up game, and you should be managing risk. If you're not, that's on you. Okay. So there we go. We've said what we wanted to say. We've said our piece. So now let's move on and have a look at the Elliott wave counts, and then we'll do some other technical analysis as well. So the primary count has us in a fifth intermediate wave, which when it concludes will result in expected crash. And that will be something like this: 1 into 2, 1 into 2, overlapping nesting structure 1 2s, 3 into 4 minor degree, 3 into 4 intermediate degree, overlapping structures 3 4s. Cannot get this to complete as 5. I try and I try and I try, and I can't get it to complete as 5. I could get it to complete here, but then we came to another swing high. So that's a little problematic, but we have an alternate count to explain that. So what I'm expecting now is a more extended fifth wave move up. So we go 1 into 2, 1 into 2, 3 into 4, 3 into 4, 5. And we work our way up in this fifth and final wave out through the summer, maybe out into autumn. Maybe sooner, maybe later. We'll know when it happens. Alright, so we're now in that fifth and final wave up, and this would have been quite a long period of time by the time it concludes. And all of this, and even then, it would just result in a larger correction. So at the moment, we are 872 days into this thing. Maybe we go out to 990 odd days or 1,000 days. You see my point? Yes, there's still some time left, but as a percentage of the overall bull market, there's not much time left. Okay, but this is all conjecture. I don't know if that's going to be the case. So on the smaller time frame, let's come and have a look at the chart. So we've talked about managing the risk on the short side, on the long side. What about managing the risk on the short side? Right. Well, for whatever reason, if you were a moron, pardon, I don't care if you take offence, I really don't. But if you shorted the bloody opening, you're an idiot. And you even then, at least you can limit your risk to 5.24%. Right. If you ran into the close shorting for some reason, you can limit it to 3.14%. But if you're a bear and you think this is an all-time high, you've got 5 down, for fuck's sake, pardon my language. So why aren't you waiting for 3 up? Right? There's your shorting opportunity. STS 38.2 to 78.6. Now you're rocking. Minimal risk to the downs. Minimal risk. Your stop is what? 1% away. Jesus Christ, guys, come on. Right, that's how you short it. We've already spoken about if you're long, right? It's all gravy, baby. The cutoff is 575 spot 42. If we break 575, I will find it again, I swear. Where is it? Where are you? There you are. It's apparently 575 spot 35. It's moved ever so slightly somehow. 575 spot 35. We move through that and we're risk off until we find a lower low. But above that, we're bullish because we've had a 1, A, B, C, A, back testing the trend. Let's just extend the corrective channel because now I'm flogging a dead horse still doing this, but I'm just making the bloody point. 1 into 2, 1, A, B, C, A, back test the trend. B, swing high, C, back test the fucking trend. Close the gap, right? Close the gap, back test the trend at the 78.6. Boom, boom, boom. 3 points of confidence to support a bullish low being in place and increasing volume into the low. If you shorted that on the open tomorrow, stop trading and learn how to. Okay? Now, that's the point I want to make there. So, now, that could be temporary, guys. That could just be a temporary low, and we could come up and then roll over and continue lower. Okay? But we're talking opportunity and cost. Opportunity cost. So this here was a probable low, and you should have been bullish off of it. It may materialise into a rally to new all-time highs. Whoop-de-doo if it does. It may roll over. If it does, you've managed risk and you're out. And you're out the trade. But this is what I mean. So now, that's how I see things. Above 575, we're moving higher and away free. Below, we're going to risk off and wait for an alternative count to play out. And the first idea, and the only one I'm going to share today, because I don't want to cover you with dozens of possible opportunities and counts, is this one. Yes, it's a flat, but it's bigger. So let's zoom out, have a look at this one. 1 into 2, 1 into 2. 3 into 4 here, not here. 3 into 4 again, intermediate degree. 3 down in A, 3 back in B, 1, 2. Yes, we bounced off the tri trend. Yes, we bounced off the 78.6. Yes, we filled the gap, but we did it because we're doing 1 down, 2 back. There's your short. There's your short. 3, 4, 5. Down we go. Okay, target zone. Come off of log. 23.6 at 555 spot 16. 38.2 at 521 spot 81. 50 at 494 spot 86. Come down into here. We await a pivot. We've broken that 575 low. The next major pivot is all the way down here. Right, this breaks the upward trend even more. This breaks it at an even larger wave degree. Okay, minor wave degree gets taken out here. So another major pivot, another feather in the bear's cap over the longer term. Remember how long these big corrections take? Really big bear markets, right? We could come down a very long way. Or it could be 3 into 4 and then we're off into 5. So at that point, this Elliott wave channel, the blue channel, will be changed into the Elliott's second method, which is taking the starting position on the 2, placing a copy of it on the 4 and projecting from the top of the 3 to find the 5. And if we were to theoretically do that now, so we say 2, assume the 4 comes in around the 38.2, but somewhere between 38.2 and 23.6, maybe here. We would draw the second Elliott wave channel like that, and that gives us an idea of where we can roughly expect the 5th to complete. Okay, and that's the alternate count. We are in a wave 4, we've done an A, we've done a B, and now we're coming back in a C. Okay, and it's going to go deeper. So let's just put those, delete that channel, we don't need that. And we'll just save the chart, we'll put that horizontal ray into there, and we'll have a super quick recap. There are other ideas, but I don't want to flood your brain or anybody else's or my own by thinking about all of them. For the meantime, let's keep it simple. Primary count, we've just done another 1-2. We're swinging to new all-time highs. We're bullish above 575 spot 35. If we break 575 spot 35 and all of that structure that we put in place breaks down, we've got an alternate idea of coming lower and away in a C wave of a wave 4. A, B, C. 5 waves down in a C in a larger flat pattern. Just keep it at that for the moment. Super simple. Stay above 575 spot 35. That's all we're looking to do. Okay. And for some reason, I lost the line again. Let's pop that back on the chart. I must have put it in the wrong folder. There it is. Invalidation point for the 1 flat A, B, C into the 2. But that is beautifully technical. right? 78.6% retracement to the tick, back testing that downward channel to the tick, filling that gap to the tick. That is, and volume coming on to the lows as well. It's about as technical as a bullish pivot gets. Right, doesn't mean it's certain. There's never any certainties in this market. But above 575.35, we manage risk, right, and we stay bullish until this trend ends. If it breaks down, we're out the trade and we wait. And that's it, guys. So now we've done that, let's have a look at some technical analysis and talk about this weakening we've been discussing, right, over the weekly, daily, weekly, monthly time frame. First thing we're going to do is bring up our exponential moving averages. Daily time, 4 hours, sorry, that was. Daily time frame, we're through the 60. Synonymous with a larger wave degree correction. So all of this was small fry, right? This is bigger fry, and this is bigger fry. This is bigger fry still, and this is even bigger fry still than that, if you know what I mean. That's even English, bro. But you take my point. We're through the 10, the 20. Both of those are still above the 60. We may cross back into it like we did before, we might not. But they're pointing down, and the 60 is now starting to point down. So lagging indicators looking a bit more bearish on the shorter term. 250 still pointing up and heading higher. Volume on the low on the daily time frame. Weekly chart. Long wick for the week to the downside, but not a clear bullish hammer structure. But we did close inside of some of the prior weekly structures we've seen here, but we didn't get inside the prior weeks. And generally, some more bearish close on the weekly time frame, but it stayed above the 20 exponential moving average. No significant breakdown. Longer wick to the downside with some volume on the daily looks kind of bullish. It could go either way. It's because it's a deep retracement, right? If it had been a 30% retracement or a 50, it wouldn't look as bad, but it was deeper. But still well above our long-term moving averages here. Let's bring up our momentum indicators. So this is where shit gets kind of not scary, but a little concerning. So the bearish divergence into these highs is getting pretty extreme. Higher high. Let's get the polyline actually to do this. Higher high. Okay. Higher high. Higher high. Higher high. Meanwhile, lower high. Lower high. Lower high. Bearish divergence. OBV confirmed higher high. Higher high, higher high, but higher high, but in the last one has now confirmed what the MACD is telling us. Bearish divergence, lower high. RSI, higher high, here, lower high, here, lower high, lower high, lower high. Every high this market makes, the RSI makes a lower high. This is weakness going into these highs. So I know what it must look like. It must look like Tom's talking about a contradiction. You see how I have the luxury of staying in the upward trend and staying in the game and trading the game while facing this bearish divergence is because my risk is minimal. That's why I have that luxury. Okay, you can have the same luxury if you choose it. My point at the end of the day is my exposure is reduced because I don't like the look of this. I have to be honest, I don't like the look of it. But if it all goes fucking flying off to the moon tomorrow and we get a higher high on the MACD and the RSI and the bear div, all of this is undone like that and we're bullish again. And that could happen. That could happen. Monthly time frame, how are things looking? Overbought on the monthly time frame and monthly divergence on the RSI. Monthly divergence on the RSI. No clear monthly long divergence on the MACD because we don't have another data point here, but we are starting to roll over. A flat top is the best I could call it, forming on the OBV on the monthly time frame. Maybe there's some divergence here. Yes, there's a little bit between highs. Yeah, between these highs there's some divergence building up on the... So we are weakening on the monthly time frame as well. And we're getting a long way away from any real kind of major support. Okay, so are we coming into a top? Yes, most likely. Is it there yet? No. We can go a long way up and still build bearish divergence over a longer term. Okay, and still go a long way up. But we're getting there. We are getting there, I think. Daily we talked about 4 hour. Let's come all the way down to the small time frame, see what we did here. So talking about shorter term trades, that's what we spoke about earlier with this pivot. and the 1 to 3% risk here, and the 3% also risk here, short side, long side, right? So we came to oversold conditions on the 4 hour, deeply oversold, bearish momentum, on balance volume, no real sign there, but bearish on the RSI, bearish on the MACD, straight to the 250 on the 4 hour, under bearish circumstances, having filled a gap, having retraced to a support level, having completed an extension, C wave extension in a flat pattern. That should have been a buy. If you know anything about any of the things I just said, that should have been a buy. Doesn't mean it has to stick and stay, but it should have been. It should never under any circumstances have been a short. Okay, so I'm going to leave the lecture there now. I hope that makes more sense. I've been going on too long as it is. Let's move over and have a look at the PCC here on the day time frame. 60 exponential moving average through the 250, heading lower towards extreme complacency and bullishness. We're not there yet, but we are closer to it than we have been for a long time. And historically, we are amongst some prior market highs. Okay, not this crazy post-COVID period, which was just nuts. But we had one here, we had one here, and we've had some here. Right, so we are entering like a preemptive complacency bullish zone, a zone where people are getting too bullish, too complacent. But we're a long way from extreme fear and bearishness, so we could whipsaw back, right? So these yellow lines, if you're new, these mark market lows, and as you can see, the predictability for the PCC on this moving average time frame to predict market lows is very good. It's not so good at predicting highs. Extreme complacency can, as we've seen here, persist for a while before the market gives up the ghost. Euphoria has a habit of doing that. So, sentiment-wise, it's a bit of a mixed bag, right? Because we're weakening into the highs, but the sentiment isn't right for a market top. Right? People should be euphoria up here. They should be, yeah, off to the moon, higher highs forever. And that's not the sentiment I'm encountering. I'm encountering bearishness while the market's up. I'm encountering fear. So that seems to conflict to me. The technicals tell me it's weakening and I need to reduce exposure. The trend tells me it's still up and I need to have skin in the game. The sentiment tells me no one knows what the fuck is going on. Welcome to trading for a living. Alright, so that's the put the call ratio. We're heading towards complacency and bullishness. We need to start being on guard about potentially extreme market conditions on the upside and getting a little too far gone. The VIX couldn't care less. Alright, I'm not even sure this fucking thing works anymore. Alright, so GFC came in at 96.40. COVID came in at 85.47. 2024 recession day fear came in at 65.73 and it lasted a few hours and it was gone. Right, and the VIX retreated in the same day it went up. We've been suppressed a long time, ever since COVID really. VIX has just been suppressed. Downward trend of lower highs still intact. Some sign of an upward trend finally forming though. Now before we have these eruptions, we tend to see, if I can just, I'll try and switch everything off. Tell you what, put it all in a folder. Can I stick it all in a separate folder? Try and tidy this up a bit. Right, switch that off, that off, that off. Right, so it's just one of those things. So downward, lower lows, lower highs, and lower lows. Right, and then we saw higher lows and basically the same highs. Lower lows and lower highs, higher lows, lower highs, lower lows, and now we're starting to see higher lows again. So maybe we're just starting to get ready for another volatility moment. It can come early, it can come late, but we tend to see some trend starting to form right before it all kicks off. Here's a swing high that breaks the prior resistances, comes back to a higher low. Can't really see it here to be honest, or here, so I'm not really sure how much use this is, but you know, what else have you got to work with? We've got a downward trend line which is still intact, the lower highs. How about we say then, breach that trend line, get a reading above 30 maybe, and things are starting to get serious again, and the VIX is starting to get elevated, and maybe but by that time we should have seen market structure start to break down. Right. So the PCC, I think, gives us more of a clue that longer term we're now getting quite far into this bull market, and we will be approaching some kind of crash or correction sooner or later. It's no sign of it being there yet. The chart suggests we're still in an upward trend and still going to push higher for the meantime, but just be on your guard. So if I can wrap this video up, I want to say thank you very much for joining me on this technical analysis of the SPY. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. If you're interested in learning all this stuff for yourself, including Elliott Wave, you can join the Patreon. There's a link in the description box below. You can go and learn all the educational material there, get access to live streams and a whole bunch of additional content, and join a great Discord. And you can follow me on Twitter as well. There's also a link in the description box below. But if I can leave on one thing, it's don't let those people out there who might have a vested self-interest to scare you out of participating. But if you are going to participate, at all times manage risk. That is your responsibility. Take care of yourselves, guys. All the best, and I'll be back with you as soon as I can. Bye bye.